It's another Wednesday, another edition of your informative program on Armourgate Radio Communications. And our theme this quarter is corporate financial strategy and sustainable growth. Corporate financial strategy and sustainable growth. I'm Abiodun Abari, your anchor. Welcome, everyone. Last time out, we were able to establish an understanding of sustainable growth and also get a grip on what corporate financial strategy is speaking to. Yes, we're able to see growth as an objective that is desirable for all rational organizations and also something that they want to do sustainably, okay? That all rational organizations pursue growth and to ensure that the going concern credentials of the organizations are ascertained. Okay, so we can look at sustainable growth, okay, from that prism of the maximum growth rate an organization can attain without additional leverage. Okay, and we always look at it. With that analogy of running a marathon, that you don't do a marathon with you don't start a marathon and with a sprint. Okay, that when you sprint is not sustainable, you might just start gasping for breath. All right, and you might not be able to finish the race in a reasonable time. All right, so we understand that for growth to be sustainable, it has to be realistic, it has to be achievable, that without resort to solving funding issues, okay, occasioned by too rapid growth or slow growth. Okay, for growth to be sustainable, it must not be too rapid, so that funding issues do not arise, and it must not be too slow, that it will now put the organization out of competition. Yes, I've also looked at the principles to imbibe when we want to achieve sustainable growth, when we want to ensure that our growth is sustainable. Okay, first we know we have to ensure that the customer or client experience is optimized. Clients or customer is king, and that loyalty to the customer should be unalloyed. Okay, because a satisfied customer is usually retained. Okay, and the goal is to surpass customer expectation. Okay. Yes, and of course we talk about the deliberate intention to grow revenue, to grow profits. All right, there must be that deliberate intention, that drive, that concentrated effort to ensure that the business grows financially. The business is not gasping financially. Okay, so and of course, and at the heart of it all, okay, is the need to be able to outwit competition, to outdo competition, except of course you have a monopoly. If not, it's very important for the sustainable growth of organization to always think ahead of the competition. And of course, the corporate social responsibility, environmental responsibility should also be adequately attended to. Okay, you want to ensure that regulations on the environment, as regards projects, and all necessary documentations and approvals are tidied up. Okay, our approvals are got to ensure that the sustainable growth of the organization is not undermined. Okay, I also look at social interventions in the community, to improve the lives of citizens, and of course look at the pursuit of renewable energy policies to ensure a future-proof agenda. Very important to ensure sustainable growth, and of course the stakeholdership. All right, the engagement of stakeholders should be holistic, because any stakeholder that is left behind might just prove to be a vulnerability for organization. Okay, any neglect might just be a kind of vital ground for opposition to the organization. Okay, and I've also been able to establish that life cycle, that the stages of growth. Okay, I'm talking about business growth. All right, I'm talking about the existence or exception stage. Okay, and that's the focus at that time is market acceptance or market validation of products and services, right? The attraction of customers and so on. So, and of course, the survival stage, which focus is actually ensuring that there is increase in revenue and profits to ensure that the business survives. And the success stage where the business has actually made a success of of the product, right? And there is now steady growth of revenues, and of course the takeoff stage, which actually necessitates structural and systemic, and of course capacity tinkering to ensure efficient handling of the rapid growth. Rapid growth that actually characterizes this the takeoff stage, and the maturity stage, which is actually talking about the numbers, relatively large numbers that have to elicit institutional strengthening, and of course renewal and reinvention of our strategies, to be able to adequately framework our sustainable growth. And in looking at corporate financial strategy, we talked about it in the context of being a holistic or comprehensive disposition, right? So, involving the use of financial tools and frameworks that enable decision makers to evaluate and determine business strategies, with a view to anticipate changes, challenges, and obstacles, and able to allocate resources optimally and enhance shareholders' value and growth. So, evidently, we talk about the financial strategy as a plan or document that's actually formulated at the highest level of management, so it actually points to how financial resources are to be used to attain preset business objectives. And of course, is the chief financial officer. We'll be talking about more about the responsibilities today. The chief financial officer that actually shows the path for achieving sustainable growth, maybe through capital structuring, plan optimization, expanding market share, and optimizing cost efficiency. So the CFO actually produces the financial strategy, is in charge of establishing financial strategy of the organization to enable sustainable growth. All right. So the financial strategy must be able to veritably equip the CFO to be able to anticipate obstacles and optimize financial resources allocation, in order to enhance shareholder value and sustainable growth. So that alignment of strategic finance with sustainable growth, among other objectives, the growth objectives and sustainable growth objectives, and among other objectives of the organization, right, will actually be enhanced, with the adaptability of the strategy to the dynamics of the business environment as well as the task environment. Very, very, very important. And we recall that the transition from typewriters to PCs, and you could imagine that CFOs that did not actually provide for the outlay to ensure that transition will actually be shortchanging their organizations, coming late to the party, and would have paid dearly for their inefficiency. So the essence of having an adequate financial strategy is to reduce the element of unpleasant surprise to the barest minimum. And we looked at strategies, approaches, talking about priority-based approach to a financial, corporate financial strategy. We looked at the strategy that prioritizes capital allocation, right? And we also looked at the one that prioritizes risk management, and another that prioritizes investment, and of course debt management, profitability, liquidity, and shareholder return. So very important to align financial strategy with the long-term objectives of organization, as well as the dynamics of the business and task environments. Of course, the continuous monitoring of an evaluation of performance, very, very important, so that the priorities can be reassessed for financial stability and sustainable growth. Strategy must be adapted to the dynamics of the business environment and task environment. So very, very important that the fluidity to ensure sustainable financial stability and sustainable growth. And now let's look at corporate financial strategy component wise. All right, we see corporate financial strategy as a futuristic determination based on dynamic parameters. All right, and at the base of it is the determination of financial goals. All right, but the financial goals have to be set. Financial objectives have to be set. Numbers, measurable, clear. Basically clear, unambiguous, measurable, and realistic financial goals. Okay, are to be set at the beginning of every business period. Very, very important that financial goals are set in terms of numbers, profitability levels, or debt levels, of course, specific margins, and maybe a return on investments. Determined, clear, unambiguous, measurable, and realistic financial goals. Well communicated, okay, are to be set at the beginning of every business period, are to be set and communicated at the beginning of every business period. So when financial goals are clear, unambiguous, measurable, and realistic, they tend to create this sense of focus and direction, right, in the organization. They also serve as a motivation for employees in the organization, because they start looking towards achieving that goal, and they drive themselves into achieving those financial numbers. All right, so that actually brings about a sense of unity that calls for alignment across departments, across units, to commonly achieve set financial objectives, clear financial goals. All right, so financial goals, all right, is very, very important component of corporate financial strategy. Okay, for corporate financial strategy being the futuristic determination. All right, so having to set financial goals for the organization in terms of numbers. All right, very, very important. So, and in terms of promoting accountability. All right, so measuring financial goals are veritable metrics for monitoring and evaluating financial strategies. All right, so they provide the basic metrics for for monitoring and evaluating financial strategies, and of course easily enabling the making of adjustments. Okay, because from the feedback of the monitoring and evaluation, you can actually ensure that they are integrated into the financial strategy and adapted to reflect those dynamics, so that you ensure adequacy and sustainable growth. Okay, so in terms of promoting accountability too, all right, so when you have measurable financial goals, okay, they are actually veritable metrics for monitoring and evaluating financial strategy. So easily one can then reward or otherwise as appropriate. Okay, so
Armourgate, founded in 2008 out of a desire to build transgenerational structures for organizations, institutions, and nations. We have worked with large businesses, international development organizations, and public sector ministries and agencies. Armourgate, our uniqueness is that we do not just work for you, we work with you. For example, we do not leave you to the task after sourcing talent that will help the new hire settle into robust leadership development programs. We are technical experts in advising and supporting institutions on strategy and leadership, artificial intelligence, strategic human resource management, public sector reform, finance, audit and tax, FAT, and strategic communications. We do all this and more out of a desire to transform nations through institutions and organizations. For further inquiries, email contact@thearmourgate.org or call +234 810 999 6666, +234 807 957 4151, and +161 0504 6026. www.thearmourgate.org. Armourgate, building to endure and transforming nations through institutions and organizations.
And financial goals are, like I said, could be specific margins, okay, revenue levels, okay, the return on investment, even debt levels, all right, and of course with accompanying timelines, all right, accompanying timelines, the goals that, okay, by the end of the 6-month period, okay, they should be achieving this sales level, or by the end of so and so period, okay, we should be able to have this level of debt reduced. Okay, we should have reduced our debt to this level, or okay, by the end of this business year, we should have so and so return on investment. No, and a very central component of corporate financial strategy is financial planning. Financial planning is actually the cornerstone of any corporate financial strategy worth its salt. Okay, very central. Right. So we talk about having a detailed and holistic determination of the financial position of the organization. Very, very important. Before you can actually do financial planning, you must have a detailed and holistic determination of the financial position of the organization. So then you can then start go ahead to plan realistically, okay, projecting revenues and expenses. You have to determine projected revenue and expenses, okay, realistic ones, okay, and of course debt levels too. All right, you have to project debt levels and of course bad debt. All right, all aspects of financial planning has to be satisfied. All right, so, and of course the risk management aspects of financial planning are very, very important to achieve financial stability. Okay, and it give a sense of direction. Financial planning actually gives a sense of direction to ensure the ability of the organization to weather storms, and ride tides. All right, so because of the uncertainty of the environment, of the business environment. All right, so financial planning will help the business navigate in those turbulent waters. Okay, navigate successfully. Okay, so financial planning will ensure financial stability no matter the storm. All right, no matter the storm that the business is expected to go through, at the end of the day, a solid financial planning will actually help the business weather the storms and ride the tides. Okay, so we also look at the financial implications and consequences of potential strategy decisions. Okay, they have to be explicitly stated. Okay, explicitly they have to be stated. All right, so financial planning also entails, all right, explicitly stating the financial applications and consequences of potential strategic decisions. All right, so this will actually aid the realistic setting of measurable objectives of growth and performance for the organization. All right, aiding the realistic setting of measurable objectives of growth and performance for the organization, and of course investment opportunities that align with overall purpose and objectives of the organization are identified and assessed. Okay, very, very important part of financial planning. Okay, that financial planning, you have to also try to identify and assess, okay, evaluate investment opportunities that align with the overall purpose and objectives of the organization. Okay, so you have to ensure optimal use of financial resources. And another component is the usage of various corporate finance techniques. All right, various corporate finance techniques. Look at tools in capital budgeting, for instance. Okay, tools in capital budgeting help evaluate the risks and project the return on potential investment, the profitability of potential investments or capital projects. Okay, so that's the essence of using our tools in capital budgeting. Okay, that to evaluate the risks and project the return on potential investments or capital projects, so that management can make optimal decisions that will ensure sustainable growth. Okay, so of course this can help to optimize yield and optimize shareholder value. Okay, yes, I'm also looking at our tools in capital structure management, tools that help to establish the optimal capital mix, that capital mix of equity and debt financing. That's what percentage of our capital should be equity, what percentage should be debt, to have an optimal capital mix. Okay, so this helps to optimize the cost of capital efficiencies. All right, optimize the cost of capital efficiencies. And we also look at tools in working capital management, tools that seek to provide a framework for the organization to meet its short-term obligations as and when due, okay, and also be able to finance its operations. Okay, very, very important. Working capital management, very, very important, must be adequate for the health of the organization, for the financial and overall health of the organization. Okay, that the organization must be able to meet its short-term obligations. Okay, as and when due to suppliers, even salaries, things. Wages, things on the short-term obligations. Okay, and finance its operations. Okay, so it involves the optimization of resources and hence the channeling of resources to strategic priorities. All right, so that helps to free up resources for strategic priorities. So resources are actually optimized. Okay, so working capital management will help direct financial resources to optimal strategic priorities, strategic areas for optimization. And we'll look at the role of the CFO. Okay, in all of this, what are the responsibilities of the CFO? Okay, in strategy development. Okay, so the CFO actually plays a pivotal role in developing and implementing a successful corporate financial strategy, because the CFO is the key executive, the top executive, and must ensure that the financial strategy aligns with the overall objectives. The overall objectives of the organization, it must be in consonance. Okay, it must be in harmony with overall company objectives, so as to be able to promote sustainable growth. Okay, so you look at the responsibility of a CFO. First, I'm talking about the leadership of the strategic finance team. Right, the CFO actually leads. He provides strategic financial leadership. Okay, so with her, he or she has to be able to give insights, okay, into economic and market conditions and the risk environment. All right, and be able to guide and help the company, the organization, top management make informed decisions that will support this long-term health, growth and stability, sustainable growth and stability of the organization. All right, and of course the CFO has to be able to integrate the financial strategy with the overall corporate, the overall company strategy, the overall organization strategy. All right, because the financial strategy is not in isolation. Right, it must be integrated with the overall company strategy. So that means the CFO must be able to align the financial planning and the budgeting forecasting component with strategic initiatives to ensure that there is a cohesion, that there's a strategic cohesion and coordination of efforts across that departments to be able to ensure that the organizational objectives are achieved and sustainable growth and stability of the organization is ensured. All right, and we also talk about performance monitoring. Okay, that is the CFO has to be able to ensure that performance is well managed, performance management, okay, monitoring, evaluation and reporting, okay, feedbacks of performance. So the CFO has to measure and monitor and evaluate financial performance and report on key performance indicators, key metrics, okay. So there will be regular reviews, regular reporting so that to help our top management identify areas of attention, areas that need to be tinkered with, areas that need to be improved, to be able to ensure accountability and positivity in the financial management of the organization. Okay, so the CFO actually ensures that the financial strategy is adequate. Okay, for it to be adequate, it must be robust enough, it must be flexible, it must be fluid, it must be adaptable. Okay, and it must be aligned with the long-term vision of the organization. Okay, it must not be in isolation. Okay, it must not be at cross purposes with the overall strategy of the organization, the overall business strategy of the organization. And at this juncture, we've come to the end of today's episode. So thanks so much for joining me, and I hope the time we spent together has been impactful. And until I come up on your devices again next time, please keep learning, keep impacting. Thank you, and God bless you.